broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to Bursa Malaysia Derivative webinar number 5, Risk Management for Futures. Now my name is Shane and the moderator for today's webinar, and today we are very honored to have invited one of the very renowned futures trainer. His name is CC Yong, to come and share with us risk management for futures. Now before I proceed, just want to check if you can hear me clearly. So if you can hear me clearly, could you please go to your control panel and click the raise the hand button. All right, let me see. All right, you can hear me clearly, please click raise the hand button. All right, I have seen half of you raising your hands now, the other half not raising yet. If you can hear me clearly, can see my screen, please raise your hand. All right, thank you everybody. You may put down your hands now. All right, now in order for us to have a smooth bandwidth and for internet connectivity, I would want to turn off my webcam. Yeah, so that we all can have a smooth internet connectivity. Is that okay? Now I'm turning off my webcam now, but rest assured this is live. All right, so now this webinar is brought to you by Bursa Malaysia Derivative, and we have a series for you. If you have followed our previous 4 series, you have learned a lot about the introduction to futures, and today we're going to talk about risk management. As you know, futures is a leverage instrument, and it could be very dangerous if you don't know how to use it correctly, if you don't know how to do your money management, how to protect your risk, and you could stand a chance to lose a lot of your capital. But today we are very honored to have one credible speaker to share with you how you can protect your trade and be successful in future trading by using proper risk management strategy. And this webinar is 90 minutes long. We will reserve some time for Q&A towards the end. Now, as usual, disclaimer. Now, this program is brought to you by Bursa. Of course, Bursa is not liable for any financial losses that you make. Now, all case studies that we do today is only for educational purpose only. In no way that the presenter, me or Bursa, will be responsible for all your financial decisions. All right, so this is merely for educational purpose only. So we have a series of webinars that we have installed for you, and the previous 4 is done already. Today we're on webinar 5, risk management for futures, and next webinar we have in next month, 7 December, we talk about futures analysis. All right, so we'll talk about fundamental analysis and technical analysis for futures in the next month. For today's talk about risk management. Now, our speaker today, CC Yong, as on your screen, turn on the webcam, he is a local participant of Bursa Malaysia Derivative. Now, for those of you who don't know, local participant LP are traders who have traded 10,000 lots, if I'm not mistaken, a month to qualify for LP. All right, he's a founder of Straits Index Sdn Bhd, a proprietary trading company and associate participant of Bursa Malaysia Derivative. He's a trader, and he's full-time trader, okay, and he's a trainer and a writer. He speaks regularly for SIDC and other financial institutions, and not only that, he's also a columnist for several newspaper and financial magazine for more than 10 years. I'm so glad to have you today here, CC.
Hi Shane, how are you?
Yeah, I am good. Right, thank you for having you here. Now I'm going to pass over the control to you and to make you the presenter. All right, so you can show your screen now. I'm making you the presenter.
All right, let me share the screen. Okay.
Yes,
screen ready?
Yes, we are seeing your screen now. Over to you.
Okay. Right. Good evening to everyone. So the honor is mine, Shane. So thanks for having me here. Today, thanks for the introductions. Let's jump to my slide. Okay. Today I'm going to talk about risk management. To me, trading, the most important thing in trading is risk management. This is what we do, or if you want to transform from a basic trader to a full-time trader, this is a part that you don't want to miss. Okay, my next slide will be something just like what Shane is actually just shared with you. Check these statements out. Okay, normally you will see this in seminars, webinars, which it sounds like the past performance is not necessarily indicative of future trading result. Okay, futures trading represent speculative investments and involve a high degree of risk, or you may see that an investor could have lose all or substantial portion of his or her investment in trading futures. So what this means? Okay, this means merely trading is actually risky, but is it very risky that we shouldn't be trading it? Okay, is that what it means? People may be asking, trading futures is good for people that could take high risk, and then as well as you have the money to lose, then only you can start trading futures. Actually, I am a full-time futures trader. Means I all my trading instruments are in futures. I couldn't agree in actually trading futures is risky. In fact, I may go extreme to say that trading futures is actually less risky than many other instruments available to you if you know the way. So probably I can share with you some of this in the later stage. But let's move on to the next slide where okay, what is the risk and in trading and all this, because trading is about risk. Why I say trading involve all the risk, because I often say that I won't say that I invested in this stock or invested in gold futures, invested in palm oil futures. I will always say that trading is to risk your money or your equity on a trade. That means you are actually risking your money on stage, and then to try to gain from the risk. Okay, and futures of course has risk. It's just like any other instrument. What I mean here is that trading futures actually carries the same type of risk if you know it correctly, just as any other instrument. Even you buying a car is not investment. Sorry, buying a house you say is an safe investment, but buying a house actually carries some risk, which you probably get a loan, or even you invested 100,000, 200,000 into a apartment or so. It actually carries some risk. Or let's we say something closer towards what we probably refer to, like buying a stock, buying a fund, buying a mutual fund. It's all carries some risk, some degree of risk. And this what I'm saying here is that trading futures actually, if you do it correctly, it actually carries the same risk like buying a stock or securities. All right. So yeah, then you have to know and understand the risk is a key to actually trading is successful. This is the most important part, and probably some traders or some basic trader may miss this out. They probably, to my throughout my experience, is that a lot of basic trader probably think that having a good system, having something to predict the future, forecast a price, knowing where is the bottom, where is the high, is the ultimate key to successful trading and make some consistent profit. To me, is totally entirely not correct. So actually knowing and understanding the risks and manage it is the key to successfully trade, from my opinion. So moving on to the next slide, you will see that actually futures trading is you just trade a contract. Okay, it's a piece of paper recognized by the exchange. Okay, and the futures contract must have some expiration date. Actually, this is actually where partially where the risk comes from, and there's a settlement of any futures contract, because futures you can trade at any price the market wanted, but it must settle at an asset or value. This contract doesn't carry any value if it doesn't track or fix at a certain asset price or tracking the asset. Okay, This is what I shared with you in the previous webinar. So in futures contract, basically it has got two type of settlement. First one is the physical delivery, and the second one is cash settle. So what is physical delivery? Okay, for example, our star product in Bursa Malaysia is palm oil, crude palm oil. Those are the contracts that it has got a physically deliver contract, which means you take the physical asset or product or commodity when it's expired, okay, or matured. Bean oil is another contract, gold and all this, okay. But we have also a cash settle gold, which you know, it will settle in a cash. I will show it in a slide later on. So our gold in Malaysia, FGLD, is actually settled in cash. Compared to gold in COMEX, they actually traded in US market. They are actually traded with 100 troy ounce delivery. That means you buy a gold contract, when it expires, they will actually send you 100 troy ounce of pure gold. Another type of contract that using cash settlement will be our FKLI, which they actually so-called deliver you the cash equivalent value of the stocks that comprises the top 30 continuous of the stocks. So this is we call cash settlement. Okay, now slowly you have to understand it's a futures contract, it's risk management. So I would say that always remember this: risk control is the center of every successful trading story. If you have been reading books, if you have been YouTube nowadays, a lot of successful traders, they have been I say they must have been sharing with you how they manage the risk, how they stretch enough on risk management and money management. If someone that share you only how good the signal are, how good if you subscribe the system, that's probably not what you should look for. You should look for something that talk about position sizing, risk management, money management, how you size a position, how much money to go in one trade, and all this. These are the most important part in trading. In fact, I will say that if you probably master, or be very good in managing the money and risk part, so a lot of instrument will be easier, in terms of trading and getting the result. So next, you have to control the risk exposed in every trade. This is the most important part. That means every time you go in, make sure that you know how much the risk you are facing, and so that you know that once things goes against you, you can actually probably we call cut loss, or you manage your position accordingly. And of course, you need to trade with the money that you afford to lose. This is actually something that well known. If you borrow the money, if you over leverage, or you trade more than you afford. Let's say, for example, if you only can trade 2 contracts, but you're trading 10, once you lose money, you lose not only 2 contracts, but you're losing 5 times of the money that you plan to lose. Then you are actually over loss, and this is not what going to be good to you. So trade with the money you could lose. From there, it actually means that you control how much risk is exposed to you whenever you're trading. So next question will be, well, is futures trading really risky? Is risky is the words surrounding futures contract, which is yes. At time years ago, I was under the impression also I should trade stocks rather than futures, because futures is rather risky. But until I realized something which I'm going to share with you today, it is not totally risky, but in trading stocks, if you compare the stocks, always that people compare stocks. Stocks, you have dividend, you collect dividend if the company doing well. But stocks, you pay full asset value. That means you're buying a stock at, let's say, 89 cents. Okay, if you're buying 100,000 share, you need to pay put up the money 89,000 ringgit in order to take up the share. So that means you are actually trading with a full asset value or full margin, as if you want, I would say that. But trading futures, usually it means you trade with margin, okay, or some leverage. But even stocks trading, or a lot of stock traders they're trading with so-called margin as well. Let's say if you put up 100,000 cash inside your account, but you're trading 300,000 or 500,000 worth of stocks, you're actually trading a margin and leverage as well. And you borrow stock, or you actually deposit your stocks from your own portfolio. These are all margin, okay? But in futures, usually people start with straight away go to margin. So what is margin? Margin is a small amount of money you put in to control one contract. I'll explain this in the slide later on. Let me slightly highlight you. If FKI value of, let's say, for example, 1780, okay, what is the value of FKI is you times 50 ringgit per point, which is actually inside the contract specification. I don't fix this. Like CPO is actually 25 ringgit per point, but FKI is actually 50 ringgit per point. So you get roughly about 89,000 worth of FKI contract, okay? But the margin that you need to put up is only mainly 4,000. So that's actually to control something that worth 89,000 with only 4,000 ringgit. So that is the part that the margin, the leverage comes in. So if FKI go against someone, or you long or short, go against you by 80 points, so you will have your margin 4,000 totally lost. You wipe up your account. So that is why people always say that futures is risky. You buy stocks, if the stock go half the price, you lost probably 45,000. But that's half, the share price depreciated. But FKI, if it actually just go against you by 80 points, you have your total account, become zero. So is that risky? So slowly, let me tell you the idea, on this risk management. You have to understand and go through a process to understand this kind of reason before you really can consistently and profitably trade futures. Okay, let me give you an idea. FKI theoretically should never go zero. For very obvious reason, it comprises 30 stocks. Okay, these 30 stocks are the top capitalization stocks, market cap in Malaysia. So this kind of companies, they never have the asset go zero. Even if they have actually go to actually the business is not as good, or some other business are better than them, they will actually replaced by Bursa, okay, they will actually get this index schedule. So assuming FKI actually stand at 18,000, 1,800 now, okay. So what's the value? The value will be times 50 ringgit will be 90,000. Okay, what if you have used 90,000 or even half the price or the cost of the asset to control one contract of FKI? So meaning to say you pay a full margin, which is 90,000, or even 50 will be 45,000 to control one contract. You need to lose 1,800 points, or let's say if half, that means 900 points to wipe out your account or margin. That means it actually shows you how resilient if you control the risk by increasing the money you put in to trade one contract of FKI. But of course, nobody put in 90,000 to trade only one contract. But I'm just giving you the idea on how to manage the risk. You can manage the risk by increasing the money that you put in. Okay, so that is the preparation that you need to understand before you really go into trading futures. If someone actually just go into trade futures because they said futures is very easy, you buy a stock, you need probably 40,000, 30,000 just to buy some substantial stocks. But buying or owning an FKI contract exposure, you only need 4,000. That's why it's easy to start, but actually it's not. If you think that way, then it could be easy, you make some money in the first 2-3 trades, but eventually once the market against you, you find it very difficult when you lose money, right? So you have to prepare yourself mentally, financially before you really start trading futures contract. That means try to save up a bit of money. Don't just put the bare minimum 4,000 to control one contract, because that become very risky. So the futures contracts on the trading risk, the risk is actually futures trading will be not as risky if you have adequate margin to withstand any whipsaw in the market. I mean, you're not over trading. Don't make yourself at any point of time over trading. Over trading can be, if your account only have 4,000 but you buy 10 contracts, or you have 40,000, you buying probably 40,000 40 contracts. These are all over trading. And if no one uses if one uses high margin leverage to trade security or stocks, the investment can be as risky. Let's say if you put in 100,000 of stocks, but you actually calling the reminder, your dealers trading like 500 or 600,000 worth of stocks, you actually almost trading as risky as futures, So futures trading is actually risk. Yeah, it has risk. All the trading has risk, but it's just that it's not so fair if you say that trading futures carries more or riskier than trading other instrument. Okay, so to make it fair, if you put enough margin or money into an account to trade a proper size, or that's we call the position sizing parts come in, where the risk become slightly smaller if you trade this way. Okay, now let's me explain a bit on some risk that you have to understand and you might be facing when you're trading futures. First, you have to understand that all the futures contract has got a so-called spot months expiration. Okay, it has got a delivery. Okay, and you have the risk of liquidity and margin requirement. These are the part that you have to think of. Okay, what are the spot months? Okay, spot month will be you're trading some contract because it's expire in this month. Okay, so it's a current and the last trading month before a futures contract expire, or you can call it matured. Okay, so basically, let's say for example, if you're trading FKI, the spot month will be this month, which is November. And if you're trading FCPO or crude palm oil, the contract of November just expired on the 15th, which is yesterday. And the spot month contract of CPO now, this you have to read the specification, is December. So December become the spot month of CPO. And some contract actually is active in spot month. For example, usually those cash settlement or cash settle contract, they have a higher call relationship in the spot month, which is like FKI and FGLD. So this you will have active contract during spot month. But some contract which is usually active in the third month, okay, which are those contract that having the physical delivery will be CPO or go in COMEX, because all the traders are trying to avoid physical delivery. So you don't want to own the oil, that's the reason why it's not active. So delivery is something that in the futures contract you have to understand. Any type of contracts you're going to trade, make sure you understand the specification, especially on the delivery part, is when is the spot month, and when usually you do not trade spot month because the margin become higher. And futures contract is a contract usually buying with a delivery option, okay, where physical delivery of the commodity or metal or any underlying asset. For example, CPO crude palm oil, is the asset. Okay, if you physical delivery means you're taking crude palm oil or COMEX gold will be taking the gold, for example. And other type of delivery will be cash settlement, which they will deliver the cash or they take out the cash from you. Like if you lose money, they take out the cash from you. So I give you an illustration on this. If you're taking delivery on CPO, they'll deliver you in oil. Or if you sell a CPO contract, you have to ship that. Every contract is 25 tons of crude palm oil. You have to ship to Pasir Gudang, you have to ship to, Port Klang to deliver your oil. Or you take delivery, you have to take, drive a truck and get the oil from this tank in Port Klang. I don't know where you want to store all this oil. So these are the physical delivery. Okay, but of course, your broker usually will advise you before the contract go to the stage of delivery. So usually they will settle with you. But of course, if you go into settlement, going to the physical delivery part and you can't take the oil, usually you suffer some losses because people will take oil from you but at discount, or they sell to you at a premium, this kind of arrangement. So another type of settlement will be cash settle. In cash settle means you will just see a statement saying that cash settle, the contract you buy or sell at this, you make some money, you lose some money, and all this. This will consider cash settlement, which it's just accounting numbers, which like you can see in the screen now. So that is cash settlement, which is easier. Okay, but if you don't go into the physical delivery phase where spot month or the contract expire or matured, you don't have to worry about delivery. Let's say, for example, I'm trading palm oil, but I never take a delivery because I'm not a consumer. That 25 tons every contract I own. So I just trade the third month onwards, or second or third month or fifth month onwards. So I don't have to worry about the delivery. So, but next thing about risk is because of all this reason, okay, traders usually focus on the active or benchmark contract month. So usually the liquidity is actually lesser for non-benchmark or contract month. So most of traders of the non-benchmark contracts are likely to be traded by only hedgers or spread trader. So if you're just trading for directional, long to expect the price go up, short to expect the price go down, it's better for you to trade only the month that with a lot of liquidity. So this is part of the idea that you have to control to know where to trade. Okay, some futures contract is physical delivery like CPO. So trader will avoid taking that spot month, otherwise you're forced to deliver or accept the delivery. So that is why the liquidity is actually smaller or lower. Another part is on the margin. Actually, margin is something that why people trade futures, because margin. You can have something that control a very big asset with very little of money, so that you don't need to be a millionaire to start trading. So you can trade with a small margin. The margin is actually set by exchange according to their formula. Okay, so a small cash margin is required to control one contract. All right. So just like what I explained to you just now. So usually it's actually lies about 5 to 10% of the contract value. And below you can see that this is the current margin rate for all the contracts traded in Bursa. One contract FKI is actually 4,000. FGLD is 700 only. And palm oil is actually, as far as I know, is 5,000 for our contract. So these are the things that you derive from all these figures, and then you get the formula to calculate your risk. Okay, so how I do it? Okay, let me share with you. A contract value is something that the total equivalent of the in terms of ringgit, how much a contract worth for, let's say, for example, BMD products. So CPO or FCPO price, let's say, for example, now let's say we will say that 2,700 is the contract value, and the contract size is 25 tons per contract. Okay, so how much is the value of only one contract? Of course, 25 tons times 1 ton price is 2,700 times 25. You will get equal to 67,500. While the FKI, the equity index, 1,700, because it's actually multiplied by 50 ringgit per point, so you get 85,000 out of it. Okay. Now, how to calculate leverage? Leverage is something that, as I said, is double whammy. leverage help you to gain to access to high value of asset by using a small amount of money. But leverage also give you over trading opportunity, which is not a good thing, which you can actually over loss because you over trading. Now, how to calculate leverage is you get a contract value, okay, you divide it by margin required. So for FKI, your leverage is actually 85,000 divided by 4,000 margin required. So you're getting 21.25 times of leverage, which means whatever you do with FKI contract, you're actually doing with 21 times of your actual money that you put in. That means you're controlling something that moves 21 times faster than you can afford, right? Or you're trading now. So CPO on another hand is 67,500 divided by 5,000. So you're getting slightly smaller leverage by trading FCPO. Have you ever heard people say that CPO has got higher risk compared to FKI? If you look at leverage, actually CPO has got slightly lower leverage than FKI. But of course, CPO is actually considered riskier because the price movement of FCPO it also tracks bean oil, which traded in US and around the world, and also trading tracking the crude palm oil, the crude oil, which traded around the world, around the clock. So anything happens in bean oil and crude oil, it will affect the price of CPO. It can get up 50 points, it get down 50 points, in the blink of eye during the market open. So that is where you may actually have some risk, or you're facing some risk because of trading this contract. So it is very hard to really determine just from here whether a leverage, how big the leverage is actually to be exactly calculate the risk. Okay, for example, what I'm trading now is trading spread of CPO. The margin for two contracts or one contract of spread, which comprises of two contracts of CPO, is actually not 10,000. I mean 2 times 5,000. No, the margin for trading spread is actually only 1,000, which means the leverage, if you calculate it that way, you will have a very, very high leverage of trading spread. But in reality, it's not necessarily the case. So you have to sort of like, go deeper on how to calculate the leverage and whether it suits you. Okay, in general, I would say if something that the leverage is about probably 5 to less than 10 is some leverage that you can find is suitable for most of the trader. If you trade something that with a very high leverage, like 1 to 10, 1 to 100, which you may find in some products offered by online broker, that means anything that go against you, it will be 100 times faster than you can imagine. So yeah, if you're trading in palm oil, it's only 10 times. Okay, if you're trading in some other instrument, it gives you 100 times of leverage. If you're trading the same size, you're actually getting something that it can go against you 10 times more than what you're trading in CPO. Of course, often people will find that well, if it's leverage 100 times, it means every ringgit or dollar that I'm making, I actually leverage up to 100 times. But it's not the case, because in trading you have to always think that one fine day the trade will go against you. So will you take or accept the loss if everything go against you? So this is the part that you have to really consider in risk, thinking about the risk. Now we go into a topic slightly more refined in terms of talking about risk. Actually, if you talk about risk, I could have talked the whole night with you, but it's all resemble or actually repeating almost the same thing. Let's say, for example, on the risk part, risk management is if you want to slightly categorize this, has got a few parts. But today we will not even talk about position sizings, which you have to probably go for it, to understand more on this. But before that, on the risk management side will be how you risk every single trade, how much you risk, okay? And what is your risk to reward ratio and your winning ratio? What is all this means in your trading and number of trades? These are just the basic idea of risk management. Let me talk to you, a few of this idea. So what is risk per trade? Which per trade probably one of the most important part, and also you will probably hear most of the time when you're attending seminar and all this. Okay, so in trading is important to know, okay, how much you can risk in every single trade. Okay, so that means how much money you're willing to lose, to put in this trade. It's never in my mind, every day when I trade every day. Okay, it's never in my mind that how much I want to make through the trade that I wanted. In fact, I have slightly how much I'm going to make if I'm successful, but most of the time I'll be concerned how much I'm going to lose if this trade go against me. So these are the part you have to consider. The conventional wisdom will always be 1% of your equity. Okay, some may be suggesting 2%, 3%. It's actually let's focus on 1% because 2-3% is actually slightly higher in terms of risk. But did I say 2%, 3% is very risky? So you find that 2% actually is 100% more riskier than 1%. So what is 1% risk? Okay, 1% risk means you will never lose more than 1% of your equity. That means if you put in 100,000 in your account, your futures trading account, every single trade that you go in, you should never lose more than 1,000 in that particular trade. This is how it looks like. You have multiple trades every day. Probably you can have up to 1,000 or 100 trades every day. Try every single contract or trades that you go in, try not to lose 1%. Or you have 100 marbles, means don't lose more than 1 marbles every time you trade. This is how this idea lies. Okay, if you practice this correctly, I'll assume that you actually probably half your leg is already in become a professional trader or full-time trader. Second will be risk to reward. Okay, how much you probably risk before you actually so-called start your trading. You at least need to know, is your system working? Okay, risk to reward is an idea. Okay, an idea that put yourself into a situation calculating how much potential in your system or the type of trade that you're involving compared to how much money you could lose if you put in the money in this trade. Is some form of expected returns or reward. That's why I call risk to reward of a trade to the amount of risk taking to capture this profit. Okay, commonly this advisable to have at least ratio of 1 to 2. In fact, some probably say 1 to 2.5, 1 to 3, or 1 to even higher. I'll say it's actually okay. To me, if it's 1 to 1, it's still okay as long as your winning ratio is high, right? So, but you must always look for something that you have chance to profit. Of course, from there you can calculate your expectancy, which every time you go in, how much money you expect to make. Okay, so what it means by 1 to 2, it will be risking. Let's say if 1 ringgit, okay, you will have profit of 2 ringgit. That's how you define your risk to reward ratio. Usually it's where or how you put your stop loss order and stop profit. Okay, if you have a system you want to test, have you ever tried using computer software to test whether whatever signal, EMA, Bollinger Band, MACD, stochastic, RSI that you put in to test and run a test for yourself, which will give you a chance to know that you put a stop profit, you put a stop loss, whether it will give you a positive result or positive expectancy in long run. I would say in long run is that you can always get a system that works very well in 1 year, 1 month, okay? But you can't get a system work very well for 10 years. Why? Because a lot of system or a lot of time when we testing our system, you will fall into a trap we call curve fitting trap, which you design something that is suited for this time frame, but not all time frame. I have been seminars, people ask me questions saying that, oh, I'm using computer software to back test, okay? It shows very good result, but after I put in real money, it's not giving me the positive result that I'm expecting. So this is actually expected. Most basic trader will fall into a trap where you get very good system out of testing, but you won't, or you very difficult to get a very good system running in real life. So you really have to understand how to develop a style or system that to trade profitably. So how this stop loss or stop profit works, okay, let me share with you on this slide is, let's say if you long a futures FKI at 1,750, okay, so what is, if your profit target at 10 points, for example, so which you put your profit target at 17 and 60, so you get a 10 points profit target, right? So this is your stop profit target. If you put in the computer, it will be a stop profit, and stop loss will be, let's say for example 1745, which is 5-point loss. So your risk is 5 points and your gain potentially is 10 points. You get a 5 to 10 ratio. So if you simplify it, so it's actually 1 to 2. Okay, this is how you define. Before that, I also want to share with you, if you're interested to test your whatever system that you intended to, you can actually download a software called Ninja Trader. It gives you some data, it gives you all the indicators free of charge. You should try it out if you able to run programs and do a back test. If you have no knowledge in programming, it's okay, because you can actually use the mouse point and click set some parameters. It gives you some testing. It gives some ideas that sometimes that, oh, if I set a 1 to 2 ratio, I have this indicator, it should works in long time, right? No. Sometimes it looks good by you using your eyes on the chart, okay? It works perfectly on paper. But if you put in a computer test without your intervention, it doesn't work. This is a situation we call confirmation bias. Means if you look at something, you always get the result. The things go through your eyes and processed by your brain. Your brain will actually assume that you see the things that you want to do. So this is a very, very bad result if you're trading by using your eyes. Look at the back test system, and you get yourself in trouble in the long run. So I always say that the biggest risk in trading, or your biggest enemy in trading, is yourself. Your brain will be the one that actually cause you to lose money. Actually, I think most people understand the risk management part side, but why not everybody can make trading as a career? So these are part that you have to really not to be just another guy. You have to really focus and stress on the risk management side. Okay, let's move on to another important element in risk management, will be winning ratio. Okay, how many times one wins over losing trades? This is very important. If you have 0 win and 1 losing trade, you can't make money. You ought to have some percentage. Usually it's defined in percent. Okay, that means out of 100 trades, or even 1,000 trades, or even 10 trades. Okay, but 10 trades will be too little. Okay, how many percent is your winning and how many percent is your losing? Okay, if you have a system that you have never tested in real life, okay, or you tested only a little bit, let's say 10 trades out, 10 trades, oh yeah, I have 8 trades is winning, but it's only 10 trades. You don't say, or you don't count it as a so-called statistically proven system. You have to have, you know, something that tested probably hundreds, if not thousands of times before you conclude your system is actually workable, either by paper trade or by using a software, or you trade, you know, real money in it. So just a rule of thumb, typically you probably need about 65% is actually a good start. Even 50-50 is actually okay, but 50-50, that means you're not going to make a lot of money, or it's very hard for you to make money because you actually just have no edge. You're just trying your luck, because flip a coin will be 50-50. So you ought to design, or you ought to find something, test yourself, or, you know, work on, read more, you know, just to get a system works, and get something that works 65%. The higher, of course, is better. Okay, but it's actually almost impossible to get something that more than 85%. If someone tell you I have a system that works 99% or 90%, it's probably, you know, not going to work over time, or this guy won't sell you this kind of system, right? So yeah, don't really look for anything that 85%. All right. Number of trades is actually as important, but although it's always overlooked by traders. Why I say that? Because just now I've been saying that if you tested only 10 trades, okay, you've been trading only 1 month, 10 trades, it doesn't count, you know. So a good system should have a realistic number of trades. Okay, you trade, or the system should fire you more signals than one trade in a year or in a month. So only an over-optimized system or something that you want to design and develop, that this system works perfectly, okay, but only one trades are generated for, you know, 1 year. Or I've seen someone that actually tested a system that works very well according to this guy, 6 trades in a year. But when I asked this guy how many, I mean, have you been traded this contract CPU? He said no, just put in a formula and test it. So this we call optimized system. Although it has got a very high accuracy, every time you go in you make money, okay, but it only works for this small time frame. In fact, look for a term, this term we call curve fitting. That means you're assuming whatever happens for last month or last year, it will happen again this year, which is not the case, you know. Trading is about, you know, almost every move every day, the price move almost in random. So, and prepare yourself to trade in a random market. That means today you see price go up, tomorrow you expect price to go up again. No, the price can just reverse. But when you see price dip, let's say drop 3% in probably 1 hour, you think the market will collapse? No, the market could just rebound, you know. So there's a lot of possibility happens in trading. It's actually that difficult, but if it's not difficult, if you manage correctly, let's say if I'm wrong, I just cut at 1%. So I'm still okay. I still can pick up the next signal and make back the 1% if possible. So if I'm still losing on the next signal, I'm losing 2% only. And then I pick up the next signal will lose me another 1%. I'm okay because I'm only down by 3%. So I pick up another signal, will probably 4% I lost because it's wrong again. And the 5th signal I pick up, okay, I lose also. So I will be down by 5%. Now, most people will stop trading from this point, okay, because 5 signals consequently you lose money. In fact, it's actually that kind of 1% system that go through, you know, makes you go through all this. Even you lose, but you can continue trading, you know. So that is the reason why you need a very, very 1% risk in terms of, you know, every trade, how much money you should lose. Okay, so don't over curve your system. Okay, and if you have only one entry or one exit in a month or year, it's considered very, very much optimized. It can make money. It could actually make money, but how long you can test one signal in a year? So after 10 years, how many trades you done? 10. Is your trade statistically proven? Not necessarily. So that is the reason why you need to have a system that able to withstand the test of time. By you create a system that you can actually almost always can trade. If you create some system that you can only test one lot in 1 year, you could actually make money in 5 years time. But are you sure you can make money in the next probably 10 years? Because you don't have time to test actually. So you will have not enough trades, to achieve a desired returns in long run. This is what I mean by, number of trades are equally important in terms of your risk management. Now, okay, my next topic will be trading risk is all part of the trading. How you manage your losing position is a very major topic. Have you any method that can help you to sort of like control if you have a losing position, how to rescue this position? If you haven't have got a system that work for this topic, you haven't have a good system yet. Of course, the most important or most basic part will be cut loss at your 1%. That is already managing a losing position. You could have more type of method to manage your position. Okay, so when you make money, it's simply easy, just take profit, right? So your successful trading, if you want to have a career in trading, if to know how to manage your losing position. Okay, this is a must actually. Besides cut loss, you can have actually other thing only in usually futures, which allow you to short selling. That means you buy something, you can sell something else, right? So minimizing losing position will be also help you to improve your winning ratio, right? So if you have, let's say you have a system that 65% time of winning and 35% time of losing, but when you lose that 35%, you try to minimize the loss by take up half of the 35%. You don't lose money, you probably scratch. That means you don't make money, you don't lose money either, just break even. And the balance is probably around less than 20%. It's actually you take some loss, 1% loss, right? For example. So you actually boost your 65% to probably 75%. Okay, so that's how you actually improve your winning ratio, by minimizing your losing position. So it is a very important strategy, especially which I most of the time I'm using spread trading, which we could have use some buy sell here. When you long a contract, you could sell something else, just to help you to minimize the losses and all this. This is how we actually doing the manage the losing position part, right? So another part in my topic will be how to about mark to market. Okay, mark to market is something that is a risk to you. Okay, in futures it measure the P&L that always change over time, because if you're trading only one contract, it's easy, just the price, current price minus your entry price will be a profit and loss. But if you're trading multiple contracts, you buy January, you sell February, then you buy March, and then you buy April, you sell May contracts. You need a very robust system to calculate your P&L. So any open position will have a floating P&L, which your broker and exchange will calculate for you, and they do a mark to market to their settlement price. And this settlement price and go against your so-called your entry price, it will be your margin call execution. That means if you shortfall in your margin, you have less money, then you need to control one contracts. You'll be margin call, and that's where your broker will call you either to top up money, to put more money to control your contracts, or you cut loss, you take a loss and you lose out. Okay, so maintaining a sufficient amount of margin in the account is important. That's why I said you have to avoid this mark-to-market margin call. So the only way to do it is every time you go in correctly, or you actually put more money than your bare minimum margin requirement. Let's say, for example, your margin calculation will be let's say, for example, 5 to 10% of the asset. Okay, which from here You see, CPO margin, it will be 5,000 over 67,000, which is a 7.4% margin requirement to control one contracts. But the exchange can still increase if the market is very volatile. Actually, last year we have been increased up to a point 6,000, you know, slightly higher than the current margin, because the market become very volatile during El Nino effect, which our production of palm oil actually drop a lot. So that's why the margin can increase and decrease over time. If you are holding contracts just enough margin, let's say 5,000, you're assuming 5,000, you're holding 10 contracts, your account is 5,000. Suddenly, the exchange can actually increase the margin to 6,000 per contract. You short of 10,000 to control your 50,000 5 contract. So you 10 contracts, you need more margin to control. Otherwise, you'll be forced to liquidate and cut loss. So that's why maintaining a margin is actually important in trading futures as well. Okay, so all in all, I almost done with my seminar, and I just want to sum up. Okay, you see, trading is, you know, whether the signal or risk control part is, you see, if you have been looking for any winning system, any system that can give you a surefire way of trading, you look at signals. All right, so whether signal is what you look for, not necessarily. To me, honestly, my opinion is that the signal only helped you probably 20-30% of time on trading successfully, but the risk control or the money management part is actually comprised at least 70-80% towards your successful in every single trade. So do not succumb to look for the best signal or perfect signal in trading. In fact, you should I hope after this seminar you'll be focused more on the risk management side rather than spend too much money, too much time on looking at the perfect signal. To me, I could have do not know where the market should go tomorrow. I'm holding some position now, but as long as I have the risk management control side on my hand, I should be able to survive tomorrow. I could have actually made some loss tomorrow, or make some small money tomorrow, but as long as I have control my risk, I have my money management and position sizings correctly in my side, I should be able to survive for the next, you know, couple of days, months, possible years. So with this, actually, this is the most important part. I have never stressed enough for the past, I don't know how many years I've been doing seminars, is that always look at risk management as your first priority in your trading, in any trading actually. So with that, I concluded my seminar today. I thank you again for paying attention. So probably from here, I'll pass back to my host today so that we can go into our Q&A session. Shen?
Excellent, excellent. All right, thank you so much, Mr. CC Yong, and we are very honored to have you here to share your idea with us. Now we are opening the floor for the question and answer session. So if you have any burning question you want to ask our speaker today, please feel free to write in the question box. Right, we'll do our best to answer as many as we can. All right, so now let me see. Oh, we have a first question is Bitcoin a future contract?
Bitcoin can be a futures contract. Bitcoin is actually an instrument. For example, I'll give you this example: palm oil contract. Okay, the palm oil that you see, the oil is a product, and then BMD created a futures contract with all the physical production factory and all this. They create a futures contract for CPO, crude palm oil. We call FCPO. So Bitcoin is a product, but this product is you don't see it. It's a product that is so virtual. It doesn't sit in somewhere. It sit in everywhere. All the I forgot the server name. So they actually it's all over the places in your wallet and all this. Okay, so now once can create a futures contract for Bitcoin, I think they might have some futures contract or CFD contracts for Bitcoin, but I've never traded Bitcoin, so that's why I can't point you to the Bitcoin. But honest opinion from me, the safest product you can have in Malaysia definitely is a BMD product, which is governed by BMD, governed by SC, governed by Bank Negara. So this will be your safest product if you want to start trading. Of course, trading all the CFD and forex and all this will give you easy start. You can start with like 100 USD. But if you look closely, our BMD products actually you can start FGLD at 700. In fact, CPU price, if you trade CPU, it will cost you 5,000 to own one contract, right? Look harder. Actually, there's another contract called spread. It's actually require only 1,000 to trade one contract, which is comprised of two outright CPO. It's only 1,000. Every point you make is still 25 ringgit. So you have a very good regulated governments regulator in all this with only 1,000 you can actually trade one contract. I think it's the safest that's why I'm trading. Okay, I'm not trading that other product that provided in the CFD platform or even overseas forex platform.
Yeah, actually,
Yep.
I have already seen CFD on Bitcoin being up, and also I think Comex is putting up plan to put up Bitcoin
Yeah.
futures lah. But anyway, this is beyond the scope of Bursa Malaysia. This is for your general knowledge only. All right. So now the next question is will you consider KLCI as a product with low return but more safe than FKLI?
Then FKY.
Yeah.
Then
Will you
the
consider
stock market.
KLCI safer and but lower return, low return but safer than FKLI, KLCI versus FKLI?
But basically the FKI is actually derived from the KLCI. So, but if you want to trade KLCI, basically you're trading FKI. Probably you mean the KLCI stocks, which in the cash market side. As I just mentioned just now, FKI carry risk if you actually trading with margin, high leverage of margin. If you are actually trading with, let's say, the pre 9,000 to trade one contract of FKI is actually as good as you buying the top 30 stocks in Bursa Malaysia, and if you keep it and roll over forever, you actually definitely will make some money. The reason is because inflation we're going to like 3-4% every year, so your FKI eventually will actually appreciate over time, at least 3-4% per year. Look at Dow Jones, it has got like from 1,000 now, like how many 10,000, 20,000, eventually it still go up, So because of a lot of factor, and just to share with you, not many hedge fund actually can beat the Dow Jones or S&P in long run. So the FKI is actually still safe, very safe instrument, but you must put in a very low leverage, which means if one contract, if you put in like 60-70,000 above and above, it should be a very safe instrument. But if you put in only 4,000 and trade one FKI, I would say your risk will be 100%, means almost 100% you will get your account wiped out in no time.
Okay, so yeah, the next question is on now understanding that stop limit order is one of the best ways for risk management. So the question is, does the market maker have a special privilege to know or view those stop limit orders which were placed by the retail investor or not?
Short answer, no. In fact, the market maker actually do not have an extra privilege compared to any ordinary retail trader. It has got a very confusing, or a lot of people miss or understanding the market maker. In fact, in FKI, for example, CPU, for example, there's no market maker in the market. Everybody is just trading. You don't have extra privilege to understand other people's stop loss and all this. But of course, you can have some technique like stop loss hunting to just trigger someone stops. But I don't see it happens in our own market. Sometimes you see a price that moves so violent and trigger stops. It's actually not caused by market maker. Market maker is just merely a trader, but they actually trade both sides by offering the bid and offer. But in fact, all this violent movement are actually caused by either arbitraging opportunities, like because CPU are trading by everyone. So if Bitcoin drop 10%, CPU would drop as bad lah. Even though there's nothing wrong with CPU. So because of this arbitraging and spread and all this, so as I said, short answer, there's no so-called secret or privilege that market maker can see your stops and all this. But there are people, always speculate that is this type of thing happens. But it could happen in other non-regulated market, which I have no experience. Shane probably has better experience than me on this. But I can safely say that in our BMD products, there's no such thing here. In fact, if you really want to understand, you can always join BMD seminars and ask BMD question on this. They have a very good surveillance system that you can't actually do it. Let's say, for example, I'll give you one example. I can't buy and sell my own contracts. If I do that, Bursa Malaysia will detect and immediately they know who actually did it. So, so about the stop hunting and all this, I don't believe it's actually any privilege happens to any market maker. No.
All right. So yeah, as for market maker being able to see the order or so, I think when it comes to currency trading which are not licensed by the government, if the broker use a market maker model, then they could have installed some kind of algorithm that could probably wipe up all your stop orders and then reverse the positions very fast. So that's why it's very risky to trade non-registered and non-regulated kind of products. So the next question is, what do you mean by position sizing?
All right. Okay. Very good question. Thanks for asking. Position sizing, probably I'll prefer to teach in my class. But yeah, position sizing will be a formula or ways how you let's say if you have an account that worth 100,000, I've been telling you to lose not more than 1%. Position sizing actually means that how to set how many lots or the size or quantity that you can trade in this particular trade, that make sure that you will not lose more than 1% of your account. This is a long answer. Short answer will probably how you segment your margin or your money in trading. Let's say if you have a fixed ratio, means every time you go in 1/10 of your money. Let's say if you 100,000, you use 10,000, 1/10, 10,000 of your money to trade. If you're trading CPO, which is 5,000 per contract margin, so you can trade 2 lots. That is the easiest way to understand what is position sizing.
Okay. Now, what backtesting computer software would you recommend which is cheap or free?
Well, like I just mentioned, the software is called Ninja Trader. So far, I find this very useful. They're actually giving away free. So yeah, this is one of the best chance you can try out all the. Yeah, you can actually program quite good, but it's not the best, but you can actually program quite well and do all the testing for yourself. In fact, you can put in your own data, which you can actually backtest all stocks, FKI, CPU on your own. The software called Ninja as in the Japanese Ninja Trader.
Yeah.
Just Google Ninja Trader, you can get it.
Okay. Now the next question is, is it good to buy options on futures to hedge the risk? Now, isn't it safer to trade options instead of futures because they're only risk to the premium paid?
Yeah, in a way, if you only do the long side or buy side of option, right? If you underwriting or selling or option, so there's a totally different story. And then trading option. Okay, maybe one thing I want to share with you is trading option. I have attended one of the seminars. The speaker actually from CME shared the idea. In fact, most of the things that we are trading, or those full-time traders are trading, like what I'm doing now, is we don't trade directly into directional product so often. We so-called professional trader, but we actually just trading as a profession. That means our job is just trading. We sometimes we are not there to always bang on buying a direction. That means we sure know the market go up or down. No, that's not what we're talking about. In fact we try to minimize the risk by all the ways I just discussed just now. By using all these methods, we try to not lose money, and throughout the process we make some money for a living, hence the so-called trading for a living, right? So option, if you do a buy side, yeah, it's actually slightly safer to hedge. But if you talk about pure trading, you need a very liquid option market to trade. But if you can always trade option together with futures. That is actually probably what I would say a proper way of trading. So that means you long futures, FKI, it doesn't go up, okay, it comes down. So what you can do is you buy a put to protect your position. That is the correct way of hedging your position with option. So by combining these two, okay, you will have a very safe way. But bear in mind, if you go into option, that means you pay the premium. If the premium is 10 points, so that means you already lost 10 points. But while your futures contract may be losing another 10 points, so total you may actually lose 10 points. But the good thing is that you only lose 10 plus 10, which is 20 points. If anything continue to go against you. So that is, yeah, the safest way. But not everybody can lose 10 plus 10 or 20 points every time you go in and wrong and all this, right? So it is a good way to trade, okay? But the cost involved is actually not as low as well because of the premium. Probably I just throw in an idea. If you have this issue of hedging, all the FKIs or any contract trader in BMD, they have a next calendar month contract. Let's say if you long FKI of November, there's a December available for you. You can always sell December just to protect your position. So that's where you actually protect your position by doing a we call calendar spread. In fact, that's what I'm doing most of the time. So yeah, it's safer, but there's cost. There is actually some kind of risk involved as well. And then when the market is actually so bad, your put will be very expensive, right? So it's not as straightforward as you can see by trading just the option plus the futures alone. But yes, it's a way of hedging. But just put in the calendar spread as another way of hedging if you want to continue to trade and put, let's say, trading futures as part of your portfolio. Yep.
Okay, I think I remember, CC, you run advanced classes one, right?
Yeah.
Yeah, for those of you who are keen to learn how to do spread trading, you can contact the speaker privately. Yeah, then he can train you how to become the best spread trader in Malaysia. All right, so now the next question is...
In fact, we will have the webinar and also seminar in Bursa Marketplace. You can check out in the marketplace for the next seminar on spread trading. Thanks, Chen, for reminding me also on this.
Yeah, no problem. Now, so hang on, yeah. Sorry, I think this question is not good. So let me skip. Now, Yeah, because sometimes when you all write the questions, you got to write in full sentences because I don't know whether you're in reference to what context. All right. So for a newbie, which should we start first? Is it FKOI or FCPO?
Okay, honest question. Honest answer. None of the above. Okay,
Oh.
if you just started, I will actually recommend you to try. It's actually FCPO, but FCPO spread trading. It's actually not the same contract. It's almost the same contract, but it's actually not the same contract. CPO to me it's directional. CPO spread is almost non-directional. CPO spread will be doing something. As I just mentioned just now, the margin is actually 5 times lower. Okay, that means you trade one contract of CPU, you need 5,000. You trade one contract of spread, you need only 1,000. But of course, you can't have 1,000 to trade one contract, right? So as I said, if you trade CPU, probably you need 20,000 just to trade one contract. But if you trade spread, 10,000 you can trade actually one contract, and most likely you can probably make some money out of it. But the dollar risk, that means every single point you make from CPU is 25 ringgit. Every single point you make from spread will be 25 ringgit as well. Why I say you should start with spread trading for a very good reason is the risk is slightly lower compared to outright. You see, outright can go even 100 points in one day, or it can just open gap 50 points, boom. If you against you, you lose money. If it's actually favor you, of course you make 50 points a day, right? But to be honest with you, I almost have none experience. The opening gap is actually favor me. Most of the time, 99% of the time, the opening gap is actually against me. Yes, I trade CPU before. All right. But in spread trading, it's almost, in fact, I have never seen any open gap in trading spread. So that's the reason why I would say start with CPU spread trading. So this is probably it wasn't really popular among the basic trader, but this spread trading is one of the contracts that most professional trader or most full-time trader are trading. To be honest, I'm trading actually spread full-time. That means all my contracts, everyone in my company, all the traders that in my company, they are all trading spreads. None of them are trading outright contract. That means the CPU contract, as you can see, other people are trading. No, we are not trading that kind of contract. But we were trading this contract because we feel like it's easier to start. In fact, I run a seminar called Best Kept Secret on futures, BMD futures, which is the CPU spread contracts. Yeah, so I recommend you to start with FCPU spread contract.
Okay, now is the method of averaging down considered part of risk management?
Okay, average down probably to me is not risk management. It's more towards managing a losing position. That means if you buy something at price 10 and then the price go to 5, you buy again, so you average down, so you get a 7.5, right? So when the price rebound to 7.5, you can just get out. So it's more towards so-called managing your losing position. But average down is actually a very risky move if the contract is very big. Let's say, for example, if you have only 10,000, okay, in your account, you can only trade one contract, right? But if the price against you, so average down again, so you use 2 margins, which 10,000 already. But you also lose money, let's say 1,000. So your margin will be 9,000, but you can't hold 2 contracts. So end of the day, tomorrow you'll be mark to market and margin call. Your broker will call you. You don't have enough margin. You added 1,000, to keep the contract, or you need to liquidate your contract. So that's the reason. Average down, I won't consider is risk management. In fact, it's actually I'm actually almost against if you trading CPU or directional trades. If you average down, you limit yourself not to do it too often. But I do average down as part of my managing my losing position. Yes, it's part of the this part, but not on the risk management part. It's actually increasing your risk. Okay, so you have to be very careful and you know what to do.
Okay. So, where to find options trading in Malaysia, because it seems very rare.
Our FKI has options considered active. Okay, there's people buying and selling, and there's like what you asked before, market maker. There's a market maker for FKI option as so it's there, but you can actually monitor the market maker. The market maker just offer you price. In fact, the market maker usually do you a good. Let's say if you want to buy a contract or option, put or call, the market maker is always there for you when you want to buy or sell something. If it's not there, in fact, you can call up your broker and request the market maker to offer you some price or size if you wanted. Let's say he offer 100 lots, you want 101 lots, so you can ask him to offer one more lot for you. Yes, you can do that, So I would say FKI option is there to be available in the FKI part, but other market probably not so active. For very good reason, because Malaysia is a very unique market. Futures has got need more and more knowledge to trade, but there's a group of people very actively trading calendar spread. They use the calendar spread as an option to hedge the position, and then a lot of foreign trader, institutional trader, they're trading FKI or they're trading CPU as a pair. That means they may actually buy FKI then sell Nikkei, or they may buying FKI they sell Dow Jones. So they're actually trading a pair. They buy palm oil, FCPO, but they sell bean oil. So that's the reason why the option is actually not really too popular in Malaysia. But because all these traders are trading at a different way. But option usually you will be seen in overseas stocks and all this, which is really not active or popular among Malaysia markets.
Okay. So the next question is, will I get a physical goal if I didn't close the FGLD open position until the settlement date?
No, because it's a cash settlement contract, and the contract we call it tracks London Gold Fix. It's not COMEX Gold Fix. It tracks the London Gold, but of course London Gold also tracks COMEX in a way. So
yeah, but London Gold is the biggest gold market.
Sorry.
London Gold is the biggest gold market.
Yeah, that's right. So so Malaysian FGLD track London Gold, but because it's cash settle, that means end of the day, if the contract expire, they will look at your entry price and the settlement price, final settlement price. If you make money, they will actually put in money into your account. If you lose the clearing house, there's a clearing house in the exchange. So if you lose money, they will deduct the amount of money from your account. So it's purely cash settle, but don't worry, because it tracks the gold price. So owning one contract of FGLD is actually as good as you owning 100 gram of gold in physical gold. Okay, but you don't have the risk of if you buy 100 gram gold, I don't know why you want to put it. You put your safety box. You need money to maintain a safety box. You deposit in some online vault. You have to pay them as well. You keep in your house, you risk yourself as well. So, but buying a 100 gram or one contract of gold in FGLD, first, nobody knows. Second, no one can rob your gold from it. But if the gold appreciates 10%, your gold contract FGLD will appreciate 10% as well. So you actually having the same exposure as 100 gram of gold, but you don't have the hassle of keeping the physical gold. Maybe one more thing I want to share with you is that, you see, buying a FGLD gold has got one additional benefit. Let's say, for example, 100. Let's say I want to buy 1 kg, 1,000 gram of gold. You probably need 170,000 nowadays. Okay, but if you buy 1 kg of gold, you only need 10,000 deposit into your account. You can own 1 kg of gold. So if the gold appreciates 10%, so you actually make 10% 170,000, you know. So, but of course you can put more money. Let's say you put half of the money, you put say 74 or 75,000 into your account to control 10 contracts. In your balance cash of 100,000, you can put in your bank, you can put in bond, you can put in mutual fund to actually get some fixed income, 3, 4, 5%, I don't know. So that means you can own 1 kg of gold. If the gold appreciates over time, you make money just like own a physical gold, but you don't have to hassle of owning a physical gold. But you can put probably 60% of your money into some fixed income, FD. It generate you some good return, 2, 3, 4, but 5% every year with 100 or 1 kg gold exposure into the investment. I think that is one of the safest or best investment you can find. But this you need to prepare yourself, calculate. You know, you have to prepare yourself to own this gold. If you thinking of owning a 1 kg gold, this is one of the way you can actually own a 1 kg gold in a safer and less costly method, I would say.
Okay. So the next question is about scalping. Can you explain a bit what is scalping, and do you think that it's a good trading strategy?
Okay. Scalping means you try to take a very small profit, buy and sell in. You make 1 point or 2 points, then you close a contract. In fact, a lot of LP or local participant or full-time traders are doing this. In fact, that is how a lot of traders are making money. A lot of traders or full-time traders that we don't buy contract. Let's say CPU at 2,500, we buy 1 lot, and then we keep until 2,700, we sell 1 lot, so with it, so that we make 200 points 1 contract. No, we probably buy sell 1 point, buy sell 1 point. We are doing like 100 times, so that we make 200 points. So that is what scalping is all about. And if you're good in scalping, you should actually join Bursa LP local participant program. Or you want to do scalping, it's actually good to join also, because only you have to register yourself as LP or local participant to enjoy. If you're doing scalping, you buy and sell at the same price, same day. Your cost, your brokerage, your exchange fee will be waived. That means you don't pay a single cent if you actually don't make money on that contract. Scratch, not to say lose money. Lose money, you have to still lose money. So okay, scalping is whether a good strategy. If you are doing a lot of outright trading, yes, scalp is actually one of the very safe way to trade. Okay, and it's actually very popular amongst the full-time traders that I know. So it's actually quite you quite actually know the market, because full-time trader don't really look at signal that can help us to make 20 points, 50 points, or even 100 points. No, either you go for scalping or you go for spread trading. So position trading wise, there are some people very good in position size trading, but most are either scalper, which trade with 2, 3 points, 5 points, even 1 point is the good profit to make. And or we are trading spread, just like I do. I do most of the time. I'm doing spread trading. So that's what we actually do, and you do get a very good picture of how trading should be looks like.
Okay, excellent. Now we have come to the end of the Q&A sessions. Then for those of you who want to get started in trading futures, you can go to find an investment bank which provide futures trading. For those of you who want to know who are the licensed investment bank, you can go to bursamarketplace.com and check out the brokers section. And for those of the broker who provide futures trading, their name and the contact details will appear there, and you can talk to any of the brokers here who are licensed. Now the next webinar will be on next month, okay, December 7, 2017. We'll talk about futures analysis. Again, we'll be having Mr. CC Yong to share with us how you can do technical analysis on FCP and FKO, and how we can use fundamental analysis as well. So by understanding how you can analyze futures fundamentally and technically, you will be able to get started in your futures trading very soon. Now I have sent the registration link in the chat box in the control panel, so please go to the chat box and register for our next session with Mr. CC Yong. That will be our last webinar series for this year 2017. With that, thank you very much for all your kind attention. CC, can you please turn the last slide for me? Yeah, thank you very much for the for being a great audience online, and we were not able to answer all questions, but we have mainly answered most of the important questions. Now, with that, thank you very much for spending your evening with us, and thank you, CC, for having us for joining us in this webinar, and may we see you all at the top of the trading career. Thank you.
Yeah, thank you.